There is a roughly 90% probability that right now, a piece of software is evaluating your financial life. And unlike the simple algorithms of the past, this one has the full autonomy to open the vault. This diagram compares the $18.8 trillion in current household debt against a sharply rising trend line of consumer loan defaults. Banks are facing intense pressure to process these volumes without a linear increase in human staff. For decades, the rule was simple: a human stayed in the loop. A computer might flag an unusual wire transfer or suggest a loan rejection, but a person squinting at a screen always made the final decision. By 2026, that person is being removed from the loop. Banks have moved past machine assistance to a model where the algorithm is granted what the industry calls transactional authority. An AI can pull your data, approve a business loan, disperse the funds, or freeze your checking account, all in seconds, without a single human ever opening the file. The human safety net that historically caught data errors or unusual spending patterns has been withdrawn, replaced by a system optimized for speed and automated execution. Two forces are driving this transition. First, machine learning models have evolved to reason through multi-step decisions rather than just matching patterns. Second, in a competitive industry, software that scales at a fraction of the cost of human underwriters is an existential requirement. Initially, the AI acts as an assistant, providing recommendations to a human gatekeeper. Today, under constrained autonomy, the human is removed. The AI acts independently within numerical boundaries. Finally, in full autonomy, boundaries are deleted, allowing the system to operate without human review. This process transfers the weight of institutional judgment to an independent machine actor, giving it the power to commit the bank's capital on its own. Any job focused purely on execution, gathering statements, checking rules, or processing standardized applications, is shrinking. Junior analysts and entry-level underwriters are finding their traditional training grounds absorbed by the model. This pattern mirrors the introduction of the ATM in the 1970s. While it automated routine cash handling, it also lowered the cost of opening branches, eventually shifting the teller's role from manual counting to customer service. The work is migrating again. As routine execution vanishes, new specialized categories are growing: model risk management and AI governance. These roles require a different focus. Instead of processing individual loans, these professionals audit the logic of the AI, checking for fairness, legal compliance, and performance drift across millions of transactions. To build a career in this environment, a professional must stop competing with the machine on speed and start positioning themselves as the oversight the system requires to stay safe. The transition to autonomous execution introduces a speed that human oversight cannot match. An algorithm can execute thousands of incorrect decisions before a human observer even notices a deviation in the data. This often stems from silent drift. A model validated during a period of low interest rates might become inaccurate as inflation rises, causing it to misjudge risk even though its underlying code remains the same. Then there is proxy discrimination. Even if race or gender are hidden, the model can learn to use correlated data, like shopping habits or specific zip codes, to reproduce biased outcomes through a technical backdoor. The network map reveals the ultimate danger: correlated failure. Multiple banks now utilize similar AI models trained on overlapping data. If a shock occurs, shared blind spots cause every bank to make the same mistake simultaneously. The errors compound instantly, freezing the financial system. By removing the friction of human review, banks have transformed isolated lending mistakes into structural risks that can impact the entire economy. When a person makes a mistake, the path to accountability is clear. When an autonomous system harms thousands of consumers at scale, determining who is legally responsible becomes a murkier challenge. You can no longer afford to blindly trust that an automated bank decision is correct or fair. You have legal rights to challenge the algorithm. In most jurisdictions, you can demand a human-readable explanation for any denial, and you have the right to request a manual human review of an automated decision that affects you. We are watching a restructuring of how economic power is exercised. If you've experienced an unexplainable account freeze or a bizarre loan denial, tell us your story in the comments. It might be the focus of our next video.